We get a Federal Reserve interest rate announcement this week. The widespread expectation is that the Fed will stand pat on borrowing costs for now. We're joined by Konstantin Birmer, Head of Fixed Income Portfolio Manager at Mackenzie Investments. Great to see you as ever. The Fed looks like it's going to play it cautious because they don't know what way the tariffs are going to pan out.
Yeah, I think the arguments for the Fed to cut here are basically non-existent, but I would say there are a few signs that should make them a little bit more cautious. I think the initial jobless claims is probably one that everyone should pay attention to. Those have been creeping up, and that is a pretty live assessment of the US labor market, and that has been deteriorating quite aggressively in the past few weeks. And once that hits the 260,000 mark, probably there's some different calculations that also have to come into the minds of the Federal Reserve.
Sorry, job losses, you mean? 260,000, yes. Right. That tends to be an important number or benchmark.
Yes, so this initial jobless claims, this is the weekly number that comes out typically on the Thursday. Mm-hmm. I mean, not this Thursday because we have a US holiday, but usually that is a fairly live or good estimator of how strong the labor market is, and that has been weakening in recent weeks.
But not enough to prompt the Fed to cut?
Certainly not for this time.
Yeah.
But if we get a few more bad reports, I think the next Fed meeting could be in play.
The G7 shindig going on, and a lot of investors around the world are looking at government debt loads. So these leaders are under pressure to demonstrate they can afford to finance these big defense and infrastructure plans they have.
Yeah. I mean, the European case, or the German case in particular, played out, I think, as perfect as it can be. They announced a few months ago this gigantic package of €1 trillion, half of it for infrastructure, half of it for military spending. And that revitalized the European economy to some extent. And the euro is one big beneficiary also of that. And the bond market in Europe kind of absorbed that relatively well because the German economy and German debt levels are pretty attuned to having a little bit more debt load, but that is not the case for all the countries around the globe. Let's say if the UK were to do a similar program, there would be a very different reaction to their bond market. The US, we've seen with the big, beautiful bill that is also not going as smoothly as maybe the bond investors would hope for. And Canada, we're in a similar camp. We've seen just recently some announcements that there will be a meaningful increase in government spending coming and towards military expenditure. And that is putting some strain on the bond market because that is crowding out investors. There's just a lot of supply of bonds coming our way in the fixed income market. Mm-hmm. And that is leading in general to slightly higher yields.
Maybe we could have a look at the US 30-year bond yield. It was running up in common with long-term, the yield was running up in common with yields on other countries' long-term bonds. It has come down. It looks like some of these deficit concerns have eased a bit.
Yeah, I mean, I think the big, beautiful bill, as terrible as the name is actually also not as bad as it is portrayed in the media. Because by all intents and purposes, the tax cuts from Trump 1.0 had to get extended, and that alone is roughly $5 trillion. But the package in itself actually ended up being maybe 2 to 3 trillion in size, so a little bit less than that. So there had to be some areas where actually some savings are being put in. And if we add the revenue that is expected from tariffs, this is actually a broadly neutral tax bill. And I think that is also like little by little sinking into the market that it is actually not as expansionary as initially assumed and as generally portrayed by reporters of a really negative fiscal bill.
That's interesting. So it's not a measure that will blow out the deficit. We've heard those suggestions.
Yeah. Exactly. It is not as bad, but it is. And I think in the US's case, there's also, we've seen a meaningful adjustment. And if I look at bond yields, and especially in inflation-linked bonds, which is always the best way to look at bonds, is the yield levels, the real yield that you get in 30-year TIPS, Treasury Inflation Protected Securities, is 2.7%. And that is basically how much your real wealth will grow over the next 30 years per annum. And 2.7% per year in real growth of your wealth is a pretty good number. And that compares quite favorably to pretty much all the other countries around the globe, with the exception of some emerging markets.
Oh, and this weak US dollar, it looks like the US dollar is at its weakness since at least 2022, certainly by the dollar index. That's good for emerging countries that issue a lot of bonds in US funds?
Yeah, so that should be like pretty much the best case scenario for emerging markets, and Brazil would be probably at the forefront of that. And the reason why that is good for emerging markets is typically those emerging markets, they borrow a lot of money in US dollars. If the value of the US dollar goes down, that means they have to pay less to pay back those debt levels. So that is good for emerging markets. And the less they have to pay back, the better the debt sustainability of that country, the more positive people become on that country, and then that should attract inflows into Brazil, into Mexico, into South Africa, Indonesia, etc. Those kind of countries, and they offer pretty high yields. You can get double-digit yields in Brazilian bonds, which is probably not a bad investment, especially also because we have elections coming up next year, which should be favorable for Brazilian bonds.